you too.
Fellow investors of Berkshire and Hathaway, Warren Buffett and Charlie Munger. I'm from originally China. Now I have a company in Michigan. I want to ask questions based on facts. I want to sell Coke, Geico, and a little book called The Wizard of Omaha, the investment philosophy of Warren Buffett in China. Through all the villages, the cities, little towns, I want to make that a reality. Cheers.
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 Zone 3?
I'm not asking a question.
Oh, yeah, just warming up. Okay.
Yeah. I will.
They always tell me to get off the stage while you're in good shape, but I'll say it.
I could quit, but you missed your chance. I'm an owner of Berkshire, and I spend 6% of my net worth to be engaged to Berkshire.
Wise decision.
I did better than, guess who? Bill Gates. I noticed Bill Gates and you were traveling on a slow boat in China. I want to go home on a fast train. You want me to cut me off? If you want me to cut out, fine. Up to the investors. I quit if you want me to quit. I come a long ways. Okay. I know I'm a problem for you. But I'm here for a reason. Because I made some money. I'm going on a train. A smile train. Yesterday or the day before at the baseball, I asked Mr. Warren Buffett, have you heard of the smile train? He said no. I'm back here to respond. This is a smile train.
Okay, we thank you, but I think that's your question. We better go to Zone 4 on that thing.
Good morning or afternoon, actually. My name is Matt Schwab. I'm from New York, Pound Ridge, New York. I actually had a question about the silver purchase last year. When you announced it, you said that you believed that supply and demand fundamentals would only be established at a higher price, reestablished at a higher price. I was just wondering if you could go into more detail about what some of those fundamentals are. I mean, we've read a lot about like battery technology and some other things.
Yeah, we have no inside information about great new uses for silver or anything of the sort. But the situation, and you can get these figures, and they're not precise, but I think they're in general they're generally accurate. You can see from looking at the numbers that aggregate demand, primarily from photography, from industrial uses, and from ornamental jewelry type uses, is close, call it 800 million plus ounces a year. And there are 500 million or so ounces being produced of silver annually, although there will be more coming on in the next couple of years. There's more coming on right now. However, most of that silver is produced as a byproduct in the mining of gold or copper or lead zinc, so that since it's a byproduct, it's not very responsive to price changes, because obviously if you've got a copper mine and you get a little silver out of it, you're much more interested in the price of copper than silver. So you have 500 million ounces or so of mine production, and you have 150 million ounces or so reclaimed silver, a large part of which relates to the uses in photography. So there's been a gap in recent years of perhaps 150 million ounces, but none of these figures are precise, which has been filled by an inventory of bullion above ground, which may have been 1.2 billion or more ounces a few years back, but which has been depleted. And no one knows the exact figures on this, but there's no question that the bullion inventory has been depleted significantly, which means that the present price for silver does not produce an equilibrium between supply as measured by newly mined silver plus reclaimed silver and usage. And that eventually something will happen to change that picture. Now, it could be reduced usage, it could be increased supply, or it could be a change in price. And that imbalance is sufficiently large that even though there is some new production coming on and there is the threat of digital imaging that will reduce silver usage perhaps in the future in photography, but we think that that gap is wide enough so that it will continue to deplete inventories, bullion inventories, to the point where a new price is needed to establish equilibrium. And because of the byproduct nature, which makes the supply inelastic, and because the nature of demand, which is relatively inelastic, that we don't think that price change would necessarily be minor. It's interesting because silver has been artificially influenced for a long time. You saw that movie about, it was William Jennings Bryan, who was editor of the Omaha World Herald and a congressman from Nebraska, and whose brother was governor of Nebraska, who was the big silver man, and they used to talk 16 to 1. The 16 to 1 ratio, I think, goes back to Isaac Newton when he was master of the mint. Charlie will know all about that because he's our Newtonian expert here. But that ratio had kind of mystical significance for a while. It didn't really mean anything. And in 1934, the government passed an act called the Silver Purchase Act of, surprisingly, 1934, which set an artificially high price for silver at that time, when production and usage was much less. And the U.S. government ended up accumulating 2 billion ounces of silver. Now, this was at a time when demand was a couple 100 million ounces a year, so you're talking 10 years supply. So there was an artificially high price for a while. By the early 1960s, that became an artificially low price of $1.29. And at that time, I could see the inventories of the U.S. government being depleted, somewhat akin to what inventories are being depleted now. And despite the fact that Lyndon Johnson and the administration said they would not demonetize silver, they did demonetize it, and silver went up substantially. That was the last purchase we had of silver, but I've kept track of the figures ever since. The Hunt brothers caused a great amount of silver to be converted into bullion form, including a lot of silver coins. So they again increased the supply in a very big way by their action in pushing the price way up to the point where people started melting it down. So you had these dislocations in silver over a 60-plus year period, which has caused the price to be affected by these huge inventory accumulations and reductions. And we think right now that, or we thought last summer when we started buying it, that at the price we bought it, that was not an equilibrium price, and that sooner or later, and we didn't think it was imminent, because we don't wait till things are imminent. We were going to buy a lot of silver. We didn't want to buy so much as to really disrupt the market, however. We had no intention of replaying any Hunt scenario, so we wanted to be sure we didn't buy that much silver. But we liked it. Charlie?
Well, I think this whole episode will have about as much impact on Berkshire Hathaway's future as Warren's bridge playing. We've got a line of activity where once every 30 or 40 years you can do something employing 2% of assets. This is not a big deal for Berkshire. The fact that it keeps Warren amused and
yeah, I didn't like
not doing counterproductive things.
It makes me feel better about all those pictures that people take over the weekend. They all use a little bit of silver.
At least it shows something that teaches an interesting lesson. Think of the discipline it takes to think about something for 3 or 4 decades, waiting for a chance to employ 2% of your assets. I'm afraid that's the way we are. It means there'll be some dull stretches.
Right. Yeah, it's less than $1 billion in silver. It's $15 billion in coke. You know, it's
a non-event.
It's $5 billion in American Express. I mean, it is close to a non-event, but if you see it there,
at least it shows the human personality at work. Very peculiar personality, I might add.
Reinforced by a partner.
Yes.
Okay, let's go to area 5.
My family is a Class B shareholder. Thank you for issuing those shares. I have one observation and one question. Your Class B share is creating a new phenomena in this country. These baby shares are not only attracting my baby boomer generation, but also X generation and eco generation, your grandchildren. My question is, this next generation would like to hear from you, your investment discipline, your lifestyle, and your philosophy of contributing the wealth back to the society in a language they can understand and communicate back to their friends when they get back to school on Tuesday. Thank you.
Thank you. Well, I appreciate that, and I would say the only speeches I give, I get a lot of requests, perhaps because I don't do them, but I get a lot of requests, including from a lot of our managers in terms of trade conventions, all kinds of things. The only groups I talk to are students, and I try to talk to college and university students, although I've talked to high school students too, whenever it fits in terms of travel schedules, and I just think that you're going to spend your time with groups talking, that rather than entertain people, that it probably is better to talk to the group who talks about it. And Charlie and I are never reluctant to talk, so we do it. Charlie has given a couple of talks. One I sent you a few years ago from USC, but there's been another one recently that I think everybody would profit by reading. So it was reprinted in the Outstanding Investor Digest, but if you write Charlie, I'm sure he'll send you a copy. Area 6, please.
Hi, my name is David Osterbahn. I'm from Kalamazoo, Michigan. This is a hypothetical question about Berkshire. It's going to take a little imagination, I think. The scenario is as follows: that the U.S. Justice Department makes a ruling that Berkshire must split into 2 parts immediately. You and Mr. Munger must decide which part to keep. You can either choose your marketable securities, Coke, Gillette, Disney, etc., or you can choose your insurance and private businesses. Which one do you choose and why?
Well, that's an easy question for me. I would choose the operating businesses anytime because it's more fun. And I have a good time out of the investments too, but I like being involved with real people in terms of the businesses where they're a cohesive unit that can grow over time. And I wish we owned all of Disney or Coca-Cola or Gillette, but we aren't going to. So if I had to give up one or the other, I'd give up the marketable securities. But it's not going to happen. So we're going to be happy in both arenas, and I look forward to being in both arenas for the rest of my life. Charlie?
Well, I'll be in a hell of a fix if I'm not in the same arena.
We'd both be in a hell of a fix.
Yeah.
Area 7?
Yes, hello to Mr. Munger and Mr. Buffett. My name is Jerry Gonzalez from Plantation. My question is, what are your recommendations of Berkshire Hathaway if Charlie Munger were in charge, or your third man in charge, your third man, which I think you said It's the CEO of Geico. What are your recommendations? If Charlie Munger were to be in charge fully, 100%, or your third man, the CEO of Geico.
Well, in due course, this corporation will have a change in management. I'm afraid we have no way of fixing that. But we do not, apart from making sure we've got good options and having some system in place, we are not obsessing about a future management yet.
No, well, the
Warren
director
plans to live almost indefinitely.
Absolutely. Although I must say, at my last birthday, somebody asked me how old I was. I said, "Well, why don't you just count the candles on the cake?" And he said he was driven back by the heat. So, but we're not going to leave willingly. And we do. The directors know who, and they have a letter that says who they think, who we think should be the ones to succeed us at both the operating aspect and the investment allocation aspect, and that those letters can change over time as we keep hanging around. But I don't worry about the fact that 99% plus of my estate will be in Berkshire Hathaway stock, or that a foundation will eventually receive that stock. So it doesn't bother me in the least. I can't think of a place I'd rather have it. And that includes my appraisal of the managers that we have who can step in and do what Charlie and I do, and who knows, one of them may even understand technology.
I think this place would have very respectable prospects if the top 25 managers all drop dead at once.
Well, that's not an experiment we intend to pursue.
No, but I see no reason to think it wouldn't continue to do quite well.
Right.
It's been lovingly put together to have a certain margin of safety.
We actually, if we have a choice, it's number 3 through 23, though, that we're 25 that we're interested in. Okay, area 8, please.
This is Raul from Walnut Creek, California. Thanks, Mr. Buffett. Thanks, Mr. Munger. Thanks for your great company. Wish I had known about it 10 years ago. You are not only the greatest, but the most honest. I want to commit 99% of what I have to Berkshire Hathaway, and I will. The question I want to ask is, how do you calculate the intrinsic value of the company? And based on intrinsic value, to me, Berkshire Hathaway looks a great bargain at these prices, especially based on look-through earnings. Is that true? And one last question I want to ask, just for fun. What do you think about telecom IPOs like Quest, USLEC? They seem to pop up 50% at opening. Does it make any sense to invest in these? Thank you very much.
Charlie, you want to tackle that?
I didn't follow that all. Intrinsic value, we give you the facts and you make your own conclusions. I like the fact that you think we're honest, but you know, if you people keep bidding up the price of our stock, honesty will only do so much for you in the future.
Yeah, we've never been tested. I mean,
Yeah.
We're very lucky. We've never had, we've never had anything that we needed really that we haven't had. And who knows what the situation would be if your family was starving or something. So our intention is to continue in a position where we'll never be tested too, I might add. The intrinsic value question, I mean, by definition, intrinsic value is the present value of the stream of cash that's going to be generated by any financial asset between now and doomsday. And that's easy to say and impossible to figure, but it's the kind of thing that we're looking at when we look at a Coca-Cola, where we think it's much easier to evaluate the stream of cash that comes in the future than it is in a company such as Intel, marvelous as it may be. It's easier for us. It may not. Andy Grove may be better at figuring out Intel than Coke. And in Berkshire, it is complicated by the fact that we have no business that naturally employs all of the capital that flows to us. So it is dependent to some extent on the opportunities available and the ingenuity used in when that cash pours in, as it does. Some businesses have a natural use for the cash. Actually, Intel has a good natural use for the cash over time as they've expanded in their business, and many businesses do. But we do not have a natural use. We have some businesses that use significant amounts of cash. Flight Safety will buy build a lot of simulators this year, and they cost real money. But in relation to the resources available, we have to come up with new uses, new ways to use cash, and that makes for a more difficult valuation job than if you've got, well, the classic case used to be a water or electric utility where the cash could be deployed and the return was more or less guaranteed within a narrow range. And it was very easy to make calculations then as to the expectable returns in the future. But that's not the case at Berkshire. We've got very good businesses, and both directly and partially owned, and those businesses are going to do well for a long, long time. But we do have new cash coming in all the time, and sometimes we have good ideas for that cash, and sometimes we don't, and that does make your job more difficult in terms of computing intrinsic value. We'll have, we're going to break after the next question. At that time, we break whenever Charlie and I run out of candy up here, actually. We're going to let everybody that you can get something to eat if you want to stick around, and we will be here till 3:30 when we reconvene at 12:30. And those of you who have been with us this morning and have had enough, we thank you for being here this weekend. We've had a terrific time with you, so I'm very appreciative of that. Let's have a question from Zone 9, and then we'll go to lunch.
Good morning. My name is Frank Jervich. I'm a shareholder from London, Ontario, Canada. My question is for Mr. Munger, and it concerns his models. And the question specifically is related to market valuation. I know I'm not going to get a prediction, that's not your bag. What I'm curious about is, there any specific touchstone models that you reflect upon and trying to gain perspective at these markets where the historic valuations are quite high? And why do you draw on those models? My second question is for Mr. Buffett, and it relates to taxation. If you were able to trade your portion of your portfolio, at least in a tax-exempt fashion, like 401k plans, or in Canada, the RSP plans, would you possibly trade more actively?
Charlie, you want to answer yours first?
Yeah. Well, the Munger system for dealing with reality is to have multiple models in the head and then run reality against multiple models. I think it's a perfect disaster to look at reality through just one model or two. There's an old proverb that says, to the man with only a hammer, every problem looks pretty much like a nail, and that is not our system. So I can't sit here and run through all the models in my head, even though there aren't that many. But multiple models is the game.
The question about taxation, it would not, if we were running Berkshire absent a capital gains tax, I don't think it would make much difference in what we do. It certainly wouldn't make a difference in causing us to trade actively. We own the businesses we want to own. We don't own them because taxes have restrained us from selling them. And as I mentioned earlier, I'm fairly sure we'll pay at least $1 billion in income tax this year. We might not, but it looks that way to me, that we'll pay $1 billion. And I could do things that at least deferred, and I certainly could do things by doing nothing that avoided paying that billion in tax, or a good bit of the billion, call it 800 million of the billion. But that is not a big factor with me. It's never been a big deal with me. I paid my first income tax when I was 13, so I guess I got brainwashed at the time, and it doesn't bother me a lot to be paying taxes. I think I'm net personally, I'm undertaxed in relation to what the society has delivered to me. And, I don't send along any voluntary payments to the IRS. I want you to understand. But I really do. I mean, there's nobody I want to trade places with, and because their tax situation is better than mine. So it would not increase the activity. I've been asked to take one more question from Zone 10. I'm not sure why, but maybe because they see that I still have candy up here. So Zone 10, please, and then we'll break.
Mr. Buffett and Mr. Munger, my name is Sanjeev Mirchandani, shareholder from Boston. First of all, thank you to both of you for everything. I have two questions. For you, Mr. Buffett, you obviously have filters that you apply on selecting people as you do on stocks. Can you tell us a little bit about what those filters are?
Filters on people?
Yes, in selecting, you have an ability to motivate people who have a lot of money to keep working. What do you look for to figure out who those people are?
Well, that is a key question, because when we buy businesses, we don't have managers to put in them. I mean, we're not buying them that way. We don't have a lot of MBAs around the office that we're...
Thank God.
Yeah. That I have not promised that they're going to have all kinds of opportunities. So, as a practical matter, we need management with the businesses that we buy. And 3 times out of 4 or thereabouts, the manager is the owner and is receiving tens of millions, maybe hundreds of millions of dollars. So they don't have to work. And we have to decide in that time when we meet them whether they love the business or love money. And we're not making a moral judgment. Charlie may, but I'm not making a moral judgment about whether it's better to love the business or love money, but it's very important for me to know which of the two is the primary motivator with them. And we have had extremely good luck in identifying people who love their business. And so all we have to do is avoid anything that on our part that diminishes that love of the business or makes other conditions so intolerable that they overcome that love of the business. And we have a number of people working for us that have no financial need to work at all, and they probably outwork 95% or more of the people in the world, and they do it because they love smacking the ball. And we virtually had no mistakes in that respect. And we have identified a number of people, Charlie and I have, in terms of proposals to us, where we've felt that they liked the money better than the business. They were kind of tired of the business, and they might promise us that they would continue on and they would do it in good faith, but something would happen 6 months later, a year later, and they'd say to themselves, why am I doing this, for Berkshire Hathaway when I could be doing whatever else they want to do? I can't tell you exactly what filter it is that we put them through mentally, but I can tell you that if you've been around a while, I think you can have a pretty high batting average in coming to those conclusions, as you can about other aspects of human behavior. I'm not saying you can take 100 people and take a look at them and analyze their personalities or anything of the sort, but I think when you see the extreme cases, the ones that are going to cause you nothing but trouble, or the ones that are going to bring you nothing but joy, I think you can identify those pretty well. Charlie?
Well, yeah, I think it's pretty simple. You've got integrity, intelligence, and experience, and dedication. And that's what human enterprises need to run well, and we've been very lucky in getting this marvelous group of associates to work with all these years. It would be hard to do better, I think, than we've done in that respect. Look around this place. I mean, and particularly you young people look around this place, look at how much gratification can come into these lives which have been mostly spent in deferring gratification. It's a very funny group of people, you shareholders.
Well, on that note of self-congratulation, let's go have lunch, and we'll be back in half an hour. Let's settle down, please, and we're going to go to, we skipped one last time, so we're going to go first to Zone 4.
Hello. My name's Nelson Arata. I'm from Southern California, and I have a question. It's not really related to intrinsic value or any of that stock stuff, but more on houses. I'm still quite young. I don't have a house yet, and I'm thinking about buying a house someday soon. And in order to do that, I'm going to have to put a down payment, which means I might have to share or sell my shares. And I was wondering if you can provide some insight on when is the best time to buy a house and how much down payment you should be putting down in relation to interest rates and also in relation to available cash and the stock market.
Well, Charlie's going to give you an answer to that in a second. I'll just relate one story, which was when I got married. We did have about $10,000 starting off, and I told Susie, I said, now you know, there's two choices. It's up to you. We can either buy a house which will use up all my capital and clean me out, and it'll be like a carpenter who's had his tools taken away from him, or you can let me work on this, and someday, who knows, maybe I'll even buy a little bit larger house than would otherwise be the case. So she was very understanding on that point, and we waited until 1956. We got married in 1952, and I decided to buy a house when the down payment was about 10% or so of my net worth, because I really felt I wanted to use the capital for other purposes. But that was a way different environment in terms of what was available to buy. In effect, if you have the house you want to buy, I definitely believe in just going out and probably getting the job done. But in effect, you're probably making something in the area of a 7 or 8% investment implicitly when you do it. So, you'll have to figure out your own equation from that. Charlie probably has better advice on that. He's a big homeowner in both senses of the word.
I think the time to buy a house is when you need one.
And when do you need one?
Well, I have very old-fashioned ideas on that too. The single people, I don't care if they ever get a house.
When do you need one if you're married, Charlie? I'll follow up here for the. You need one when your wife wants one.
Yeah, yes. I think you've got that exactly right.
Yeah. Sure.
Gregory Crawford needs to go to the security office, please, for emergency message. Gregory Crawford to the security office for emergency message. Thank you.
Okay. Hope it isn't a margin call. Okay, we'll go to zone 1, please.
I'm Ralph Pfeffer from Phoenix, Arizona. The question I'm going to ask does not pertain to Berkshire Hathaway. But I would appreciate it if you gentlemen, if you can, explain the justification and rationalization for the exorbitant salaries, bonuses, perks, directors' fees, and other benefits that most public corporations are paying.
Well, I would say this. In my own view, the most exorbitant are not necessarily the biggest numbers. What really bothers me is when companies pay a lot of money for mediocrity, and that happens all too often. But we have no quarrel in our subsidiaries, for example, for paying a lot of money for outstanding performance. I mean, we get it back 10 or 20 or 50 for one. And similarly in public companies, we think that there have been managers and are managers who have taken companies to many, many, many billions of market value, more than would have happened with virtually anyone else. And they sometimes take a lot of money for that. Sometimes, as in the case of Tom Murphy at Cap Cities, it just didn't make a difference to him. I mean, he performed in a way that would have justified huge sums, but it wasn't. I mean, he would tell you that he had all the money he needed, and he just didn't care to take what the market might bear. But I am bothered by irrational pay systems, and I'm particularly bothered when average managers take really large sums. I'm bothered when they design or have designed for them systems that are very costly to the company, maybe partly to make themselves look good because they want huge options themselves, so they feel that they give options widely throughout the company. So they design a system that is illogical company-wide because they want one that's illogical for them personally. But large sums per se don't bother me. I'm not saying, whether any individual might want to take them or not. But I do not mind paying a lot of money for performance. It's done in athletics, it's done in entertainment, but in business, the people who are the 200 hitters and the people who would not attract a crowd as an entertainer have worked it out so that, the system has evolved in such a way that many of them take huge sums, and I think that's obscene, but I can tell you there isn't much you can do about it. The system feeds on itself, and companies do look at other companies' proxy statements. Every CEO does, and they say, well, if Joe Smith is worth X, I have to be worth more. And they tell the directors that certainly you wouldn't be hiring anybody that was below average, so how can you pay me below average? And the consultants come in and ratchet up the rewards, and it's not anything that's going to go away. It's like we were talking about campaign finance reform earlier. The people who have their hands on the switch are the beneficiaries of the system. Who have their hands on the switch are the beneficiaries of the system, benefiting enormously and perhaps disproportionately from that system. Charlie?
Well, yeah, I'd like to report that the original Vanderbilt behaved even better than the people at Berkshire Hathaway. He didn't take any salary at all. He thought it was beneath him as a significant shareholder to take a salary. That ideal, I'm afraid, died with him.
Yeah, Charlie Charlie and I, our directors are paid $900 a year, but I tell them on an hourly basis they're making a fortune because we don't work them that hard. But what Charlie and I did not think through when we established that $900 a year is that they set our salaries too. So we have not followed the standard procedure, which is to load it on the directors, and the directors shall load it on you.
I do think it will have pernicious effects for the country.
Load it on you.
I do think it will have pernicious effects for the country. It's escalating because I think you're getting at the very top, corporate salaries in America are too high. And that is not a good thing for a civilization when the leaders are regarded as not dealing fairly with the institutions that they had.
You know, if
all I can say is that prostitution would be a step up for them.
Put him down as undecided. Zone 2, please.
I'm Dan Blum from Seattle, Washington, via Cambridge, Massachusetts. I want to ask whether the issuance of Class B stock has achieved the objective which you announced for it when it was created.
Well, I would say this, that considering the alternatives we faced, which was the imminence of unit trusts that would have been promoted with heavy front-end commissions, with substantial annual fees, with bad tax consequences, and with probably a misrepresentation of the historical record in such a way that people who really didn't know much about securities would have been enticed in. With that as an alternative, I think the B stock was the best thing we could have done, and I feel good about how it's worked out. I think that, you know, we didn't set out to issue it. We don't like talking anybody into buying our stock, but I don't think in any way that the group we have here is diminished in the least by having a mix of B and A shareholders as opposed to A only. The B has worked out as well as possible. I hope that we haven't enticed anybody in with unreasonable expectations. That's the biggest thing that Charlie and I worry about. And it's hard not to have that happen with the historical record. I know it would have happened in a big way with the unit trust. So, it's like making the mistake originally of starting with Berkshire. I think we enjoy things as they come along, and we've gotten a good group with the B shareholders, and we're happy with the present situation. Charlie?
Yeah, we wanted to step hard on what we regarded as a disreputable financial scheme, and that we did.
And I think the way we sold the B was such as to attract the kind of people who really did look at it on a long-term basis. We did everything we could to discourage people who thought they were going to make a lot of money in a hurry. So I think we attracted a whole new group of shareholders who were quite similar in perspective to the shareholder group that we already had, and that was our hope. Zone 3, please.
My name is Alan Rank from Pittsburgh. I first want to thank Susan Jacques for returning the cocktail yesterday, and I hope she was rewarded with good sales at Borsheim's. Question is regarding the fact that you don't report details of anything under $750 million, and with the change of the values of small cap in relation to large cap, would that be something that Berkshire or individuals might try to look as opportunity with the small cap premium shrinking as it has?
We don't worry about whether a stock is small cap or large cap, except to the extent that by now we've gotten to a point where anything below a certain level just is not of interest to us because it can't be material to our results. So we never think of opportunities as existing because of something as small cap or sectors or all that, what generally gets merchandised. So our cutoff point is set more or less at the point where we think it's material. That's not as defined by the SEC. We could have a higher limit, but we think when you get down below 2% of assets or thereabouts, that the reporting of positions would not affect anybody's calculation of intrinsic value or give them insights about the way we run the business, but it would be more for the people who are looking for things to piggyback on. And so we will move the cutoff point up as we go along. Because of our size, we will never be in companies that have capitalizations that of $500 million or $1 billion, because we just can't put enough money in. Occasionally we'll be in one just by accident, but we're looking at things that we can put $500 million in ourselves, at least. At $500 million, a 5% position is a $10 billion market cap, and that limitation has hurt, will hurt, is hurting our performance to some degree. If Berkshire were exactly 1/100th of its present size, in all respects owning the operating businesses it did, but all 1/100th the size, our prospects would be better than they are with the kind of money we have presently. Charlie?
I've got nothing to add.
Okay, zone 4, please.
Okay. My name is Tom Conrad. I'm from McLean, Virginia. I just wanted to first thank you, Mr. Buffett and Mr. Munger, for each year answering our questions. I found myself at 5 a.m. standing outside the door here, and I don't do that for anyone. And it's a real pleasure to hear your answers. I have two questions. One is, with Travelers, the company Travelers, and their merger with Citibank, do you have confidence in the management of Sandy Weil? My second question is, you said it in a few meetings ago that diversification is a protection against ignorance. And it only takes 3 great companies to be set for an investment lifetime. And I invested in those 3 companies, Coca-Cola, Gillette, and Disney. And I went ahead and invested in a 4th company without asking you. I invested in Pfizer. And I just wonder what you think about the pharmaceutical industry, if you feel there's some great companies in that industry. Thank you very much.
Yeah, well, we think Sandy Weil is a very, very good manager. Sandy is, the record is clear. It is not easy to manage in Wall Street. And Sandy has done an excellent job there, as well as in other allied or somewhat allied fields. So his record is proven. And he has done ever since buying commercial credit from Control Data, he's built a terrific company. And he's built a terrific company in businesses that themselves aren't necessarily so terrific. So it's required real management skill. Pharmaceuticals, we missed. We would not have known how to pick out any single business, but single company within the industry. But we certainly should have recognized, didn't do anything about it, that the industry as a whole represented a group that would achieve good returns on equity, and where some sort of a group purchase might have made sense. We did buy one a while back, but it was peanuts, and it would have been it was within our circle of competence to identify the industry as likely to enjoy very high profits over time. It would not have been within our circle of competence to try and pick a single company. Charlie?
Yeah, we stupidly blew that one.
We'll blow more, too. Yeah. Zone 5.
Yes, sir. Good afternoon. My name is Matt Lovejoy from Lexington, Kentucky. And gladly, I'm not a consultant. I have a question, sir, Mr. Buffett, about your operating management style. In my opinion, the mainstream media minimizes the significance of your non-public operating investments. When you consider capital allocation in these companies, do you have the managers submit annual business plans? And if so, do you formally meet with those managers to see how well you can track progress against those plans?
Yeah, that's a good question, and the answer is that we may meet with some of them annually, we may meet with others semi-annually, but we have no formal system whatsoever, and we will never have a formal system. We don't demand any meetings of any of our managers. We have no operating plan submitted to headquarters. Some of the companies use operating plans themselves, some of them don't. They are all run by people who have terrific records, and they have different batting styles. And we're not about to tinker with somebody that's batting with 375 just because somebody else holds the bat a little differently or uses a different weight bat or something of the sort. So we believe in letting them do currently and in the future what has been successful for them in the past. And different people have very different styles. I've got my own style, but we have managers that like to talk things over. We have other managers that like to go their own way. And we have managers that have a by-the-book approach, which works well. We have other managers that wouldn't dream of that. We have managers that, most managers probably have monthly statements of financials. We have other managers that don't. And that really isn't a problem. What we want to have is good managers. And there's more than one way to get to at least business heaven. And we have a number that have found different ways to get there. So we have never imposed, we have certain requirements because we're a public company and SEC requirements and Internal Revenue Service coordination, but we have never imposed anything from the top on any of the operating managements. We have MBAs running companies, we have people that never saw a business school, and talent is the scarce commodity, and when you find talent and they've got their own way of doing things, we're delighted to have them do it. More than letting them have them do it, we want them to do it their way. We don't want to change them. Charlie?
Yeah, the truth of the matter is that we have decentralized power in the operating businesses to a point just short of total abdication. And we don't think our system is right for everybody. It has suited us and the kind of people that have joined us. But we don't have criticism for other people like Emerson Electric or something who have operating plans and compare performance quarterly against plan and all that sort of thing. It's just not our style.
Yeah, we centralize money, and everything else we decentralize pretty much. And I don't know whether you've met him here, but for example, Al Yoshi is here. He started flight safety in 1951, and I don't know what he'll spend on simulators this year, but it could easily be $100 million or thereabouts. And if I spent hours with him, I couldn't add 1/100th of 1% to his knowledge of how to allocate that money. I mean, it would be ridiculous. It'd be a waste of his time, and it would be an act of arrogance on my part. And I have no worries about how Al allocates the money. And that's an unusually capital-intensive business compared to most of our businesses. There's some that I get into the details more because I've just worked with a person that's running things a long time, and we kind of enjoy it. Ajit and I talk virtually every night about the reinsurance business. I am not improving the quality of his decisions at all, but it's an interesting game, and I like hearing about it, and he doesn't mind talking about it, so we talk them over. But that's just a matter of personal chemistry. And as we add managers, we will adapt to them. We adapt our accounting systems to a degree to them. Now we do have certain requirements that result from the SEC and IRS, but we don't. Our managers know their businesses, and they know how to run them. And if they don't, this hasn't been the case, but if they didn't, we would we'd do something about the manager. We wouldn't try and build a bunch of systems. Zone 6, please.
Good afternoon, gentlemen. My name is George Donner from Fort Wayne, Indiana. My question has to do with estimating the intrinsic value of a company, in particular the capital-intensive companies like you were mentioning. I'm thinking of things like McDonald's and Walgreens, but there are lots of others where you have a very healthy and growing operating cash flow, but it's largely or completely offset by heavy expenditures on putting up new stores or restaurants or building a new plant. And so my question is, what do you do for your estimate of future free cash flow? And with treasuries around, long treasuries around 6%, at what rate do you discount those cash flows?
Well, we discount at the long rate just to have a standard of measurement across all businesses. But we would take the company that is spending the money as it comes in, and they don't get credit for gross cash flow. They get credit for whatever net cash is left every year. But of course, if they're spending the money wisely, even though you have to discount it for more years, the growth in cash development should offset that, or they weren't investing it wisely. The best business is one that gives you more and more money every year without putting up anything to get it, or very little. And we've got some businesses like that. The second best business is a business that also gives you more and more money. It takes more money, but the rate at which you reinvest the money to get that growth is a very satisfactory rate. The worst business of all is the one that grows a lot and where you're forced in effect to grow to stay in the game at all, and where you're reinvesting the capital at a very low rate of return. Sometimes people are in those businesses without knowing about it. But in terms of discounting, in terms of calculating intrinsic value, you look at the cash that is expected to be generated, and you discount back. In our case, we use the long-term treasury rate. That doesn't mean that you pay the amount that present value calculation leads to, but it means that you use that as a common yardstick, that treasury rate. And that means if somebody is reinvesting all their cash flow the next 5 years, they better have some very big figures coming in down the road, because at some day a financial asset has to give you back cash to justify you laying out cash for it now. Investing is the art, essentially, of laying out cash now to get a whole lot more cash later on, and something at some point better deliver cash. Ben Graham in his class we used to talk about what he called the Frozen Corporation. And the Frozen Corporation was a company whose charter prohibited it from ever paying anything to its owners, or ever being liquidated, or ever being sold. And
sort of like a Hollywood producer.
Yeah. And the question was, what was such an enterprise worth? Well, that's sort of a theoretical question, but it forced you to think about the realities of what business is all about. And business is all about putting out money today to get back more money later on. Charlie?
I do think there is an interesting problem that you raise, because I think there is a class of businesses where the eventual cash back part of the equation tends to be an illusion. I think there are businesses where you just keep pouring it in and pouring it in, and then all of a sudden it doesn't work and no cash comes back. And what makes our life interesting is trying to avoid those and get on the alternative kind that drowns you in cash.
The one figure we regard as utter nonsense is the so-called EBITDA. I mean, the idea of looking at a figure before the cash requirements of merely staying in the same place, and there usually are. Any business with significant fixed assets almost always has with it a concomitant requirement that major cash be reinvested in order simply to stay in the same place competitively and in terms of unit sales. To look at some figure that is before that is stated before those cash requirements is absolute folly, and it's been misused by lots of people to sell lots of merchandise in recent years.
It's not to the credit of the investment banking fraternity that it has learned to speak in terms of EBITDA. I mean, the idea of using a measure that you know is nonsense and then piling additional reasoning on that false assumption, it's not creditable intellectual performance. And then once everybody is talking in terms of nonsense, why, it gets to be standard.